Hey there, and welcome to Costa Doing Business, the podcast where faith, finance, family, and freedom intersect. Here we break down the big ideas in finance, investing, and wealth building so you can make smarter decisions with your money. I'm your host, Bob, and today we're diving into a topic that sounds intimidating, but is actually super powerful once you understand it. We're talking about stock options. Whether you're an employee trying to make sense of your compensation package, an investor exploring new strategies, or just someone who wants to understand what on earth people are talking about when they say calls and puts, this episode is for you. So grab your coffee, your notepad, or just your curiosity, and let's get into it. But before I begin, here's the legal stuff. The content presented in this podcast is intended for informational and educational purposes only. It does not constitute investment advice, financial guidance, or a recommendation to buy and sell any securities or financial instruments. Listeners are encouraged to conduct their own research and consult with your financial advisor before making any investment decisions. End ridiculous voice. You know, I could afford to hire someone to read that to you if you would like and subscribe to this podcast, specifically on Rumble. Join us over there, rumble.com. Look for Costa Doing Business. But back to options. What are stock options? Stock options are basically a contract that gives you the right but not the obligation to buy or sell a stock at a specific price on or before a certain date. So, in the case of a call, we're going to buy a stock at a specific price. And in the case of a put, we're going to sell a stock at a specific price. Options are not traded in shares like stocks, they are traded in contracts. One contract is the minimum that can be traded, and one contract generally controls 100 shares of a specific stock. When options are quoted, however, they are quoted on a per share basis. So if you want to find out the total price of one contract, you have to multiply it by 100. Now, there are two main types of stock options. There are call options, which give you the right to buy a stock at a set price. You are the option holder, and thus you are long or bullish on that stock. If you don't understand stock market jargon, that means you expect the price of the stock to go up. You're bullish. Like a bull's horns, they go up. A put option, this gives you the right to sell a stock at a specific price. You, in this case, you are the option writer and you are short or bearish on that stock. Again, stock market jargon, bearish, meaning the way that a bear attacks, the claws go down. So you're expecting that stock to go down. So think of it like this. A call option is like putting a deposit on a concert ticket or anything else of value. You're locking in the price now, and even if the ticket becomes more expensive or more valuable later, you've locked in a set price. A put option is like having insurance. You're locking in a price to sell just in case the value drops. Now, why would anybody want to do this? That's a great question, so let's talk about it. Why would you use stock options? Stock options can be used for a few different reasons. Number one is speculation. This is when a trader, in this case you, is trying to profit from price movements. If you think a stock is going to go up, you might buy a call option. And if you think it's going to drop, you might buy a put. I wish I could have bought some puts today, because in aftermarket trading, I saw one particular stock that went down by $20 a share just in aftermarket trading. So if I bought a put today, that put would be a lot more valuable tomorrow morning. The second reason you would buy a stock option is hedging. Again, it's like buying insurance. If you own a stock and you're worried it might fall, you can buy a put option to protect yourself. The third reason you might buy options is employee compensation. Many companies offer stock options as a part of their employee benefits. We'll dig into this more in just a bit. Options can be powerful tools, but they're not without risk. So let's break down how they actually work. The mechanics of a stock option, uh, every stock option has a few key components. The first component is what we call the strike price. This is the price at which you can buy or sell the stock. Options are not written on stocks whose trading value is below $5 a share, and the strike price differs as stock prices go up. So you can't buy a strike price at different integers. You have to buy them in increments. So between $5 and $25 stocks, the strike price is increments of $2.50. So in other words, a $10 stock would have strike prices of $10, $12.50, $15, so on and so forth. Between $25 and $200, the strike price of a stock is increments of $5. So a $100 stock would have strike prices available of 100, 105, 110, and so on. And above $200, the strike price is in increments of $10. So, for instance, a $200 stock or a $300 stock would be 300, 310, 320, 330. The expiration date is something that you need to understand and know. This is the deadline for using the option. Put another way, it's the last day the option can be exercised. The expiration date is usually the third Friday of every month. The premium is the price you pay to buy the option itself. It is the price that a buyer is willing to pay and a seller is willing to guarantee or accept to guarantee the fulfillment of the obligations of the option contract. So it is possible to sell options and receive a premium, just like it's possible to buy options and pay a premium, depending on your strategy. So let's say, for example only, that you buy a call option for Tesla at today's closing price of $438.97. To buy 100 shares of Tesla at today's closing price, you would have to have $43,897. And if that was all the money that you had to invest, no responsible investment advisor would ever recommend 100% of your investable cash in one stock. As a general rule, you should never have more than 20% of your portfolio in a single stock, and that includes stock options in the company that you work for. However, I can control 100 shares of Tesla stock with a strike price of $440 expiring in 1 month for an option premium of $30 a share, or a total of $3,000 per contract. So in this example, I don't have the $44,000 to buy 100 shares of Tesla stock, but I can spend $3,000 on a call option, control 100 shares for 1 month. It's kind of like renting someone else's shares. And if the stock goes up to $500 by the end of that month, I can buy it at $440 a share and sell it at 500 or a $60 per share profit for a total of $6,000 minus the 3,000 I paid for the option. So I paid 3,000 and I will receive 6,000 in this example. That's 100% return on my investment in just 30 days. If you could do this every month of the year successfully, number one, I want to be your new best friend. And number two, you would make a 1,200% return in your account. But if the stock stays below $440, your option is worthless, because why would someone pay $440 for a stock that's now trading at 430, and therefore you lose the entire premium that you paid? So yes, options can be risky, but they can also be strategic. Let's do another example just to sort of reinforce this principle. Imagine you think that Apple stock, again, for educational purposes only, not a recommendation. Let's say you think Apple stock is going to rise. It's currently trading at $258.45 at the close of trading today. So you buy a call option with a strike price of $260 expiring in 1 month, and you pay a premium of $8 per share. If Apple goes to 280 in the next month, you can buy it at 260, sell it at 280. That's a $20 gain per share minus the $8 premium. So that's a $12 profit per share on an $8 investment. So that's over 100% return. But what if Apple stays below $260? In this case, you're not going to exercise the option and you're out the $8 premium. That is, however, your maximum loss. Let's talk a bit again about employee stock options, because this is where a lot of people first encounter stock options. Companies, especially startups and tech firms, often offer stock options as a part of employees' compensation. They're in two types. One is incentive stock options, otherwise called ISOs, or non qualified stock options called NSOs. Here's how it works: you are granted an option to buy your company stock at a set price. That's called the exercise price. You can't use them right away. They vest over time, maybe 25% per year over 4 years. So at the end of 4 years, you can now buy the shares at the 4 year ago price. So once vested, you can exercise the option, buy the stock at the exercise price, even if the market price is higher, which is quite frankly the only reason that you would exercise the option. This can be a great way to build wealth, but it also comes with tax implications and risks. So, as always, read the fine print and talk to a financial advisor. Here are some common strategies using options. There's the covered call, and this is when you own a stock and you sell a call on it. You collect the premium, and if the stock goes up, you might have to sell your stock, but you're going to sell it at a profit and keep the premium. The protective put is when you own a stock and you buy a put option to protect it against a drop in price. And then there's always the straddle. This is for those that can't make up their mind, so which direction a stock is going to go. So they buy both a call and a put at the same strike price. You're betting on a big movement up or down, and the only way you could possibly lose money is if the stock stays stagnant in price all the way to the expiration date. These strategies can help you manage risk or generate income, but they require careful planning. So be careful. Risks and rewards, let's be real, options aren't for everybody. The upside is leverage. You can control a lot of stock for a small upfront cost. Think about my Tesla example. You can buy 100 shares for $44,000, or you can rent 100 shares for a month for $3,000. So this is good for investors that have small investable balances to put at risk, but yet want to buy some of the pricier stocks on Wall Street. The downside is you can lose 100% of your investment if the option expires worthless. So before you jump in, make sure you understand the risks, the terminology, and the math. And again, talk to a pro if you're uncertain. Let me offer you some final thoughts to wrap this all up. Stock options give you the right, but not the obligation, to buy or sell a stock at a set price. They can be used for speculation, hedging, or compensation. They come with risk, but also with opportunity. If you're curious to learn more, there are tons of great resources out there, and we'll be covering more advanced strategies in future episodes. So stay tuned for spreads and strangles, which we'll talk about in our next episodes. Thanks for tuning in tonight to Cost of Doing Business. If you found this episode to be helpful, share it with a friend, loved one, neighbor, stranger, enemy. Share it, please. Leave a review. And don't forget to follow us on rumble.com so that we can get the account to creator status. And also so you don't miss what's next. Until next time, I'm Bob, helping you make smarter moves with your money. And this is Costa Doing Business. Thanks for tuning in.